Okay, I will say just a few words before your talk, and our guest today is Alfonso Puorro from the Bank of Italy, and I would like to thank Alfonso for accepting our invitation. So thank you very much, Alfonso. And Alfonso will talk about automatic trading, and the title of his talk is very, very interesting. I mean, advanced trading systems, aggressive and unfair speculation, or instruments featuring a positive impact on overall market quality. And so that's a very, hot topic, and also I look forward to hearing your answer to this question. And so thanks again, Alfonso, and now, the floor is yours. And
okay, perfect. Perfect. First of all, let me thank you for your invitation, for giving me the opportunity to talk about what is for me a very important topic, and maybe underrated. And I'm not giving you answers. I'm sure I will offer you additional questions regarding the topic, and I will be happy to discuss with you at the end, because even though my presentation is a pure presentation about speculation, about modern system of speculation, which are aggressive, apparently unfair and harmful, I will try to offer you a balanced view in the attempt to make all the positive aspects to resurface, because in theory, all the speculation could be harmful, but in practice, for market practitioner, and I am a market practitioner, speculation is key for correct functioning of modern markets. So just a few words regarding myself. I'm Alfonso Puorro from the Bank of Italy. I am the responsible at the moment, since 2020, of the unit in Bank of Italy, the desk in Bank of Italy, looking after the conduction of the monetary policy operations. In a few words, my desk just conduct the operation on behalf of the ECB, required to transmit the monetary policy impulse from the ECB. So we just purchase tons of assets, in particular Italian BTPs, for monetary policy purposes. But before coming into the monetary policy side, I've been for more than 10 years a portfolio manager, a reserve portfolio manager. I've been managing a multi-billion portfolio for the Bank of Italy, in particular the US dollar denominated portfolio of Bank of Italy, which is roughly 30 billion portfolio, which is quite huge. And the Bank of Italy has a direct, as most of the modern central bank, has a direct involvement into marketplaces, because we as investors are currently involved into active management. At the end of the story, we have to generate some profit for the bank. So we deal with other market participants, we deal with dealers and speculators. So we know how they behave because we act with them. We have to understand the purchasing and selling behaviors in order not to be front-runned or not to offer them unfair profit opportunities. So last thing before starting, all the words you are going to listen from me are just personal. They do not involve the institution, so they are just my personal view regarding the topic and not the Bank of Italy view. Okay, moving along with my presentation, this is the outline. So this is the outline of the presentation. We'll start with a breakdown of the algorithmic and advanced trading industry. Then we will move to the high frequency trader issues, the issues related to high frequency trading, which are just modern arbitrageurs, but not only arbitrageurs. Then I will try to offer you some common metrics in order to measure market quality. And I will try to assess the potential positive impacts related to the growing presence of HFTs, high frequency traders. This is the good part of the story. At the center of my presentation, I will try to assess the aggressivity, the bad side of the moon related to those kind of traders, just trying to offering you a case study. On the back of the case study, I hope we will be able to understand which are the potential negative effects and the potential relevance in terms of general system, the systemic relevance of such traders. And then we'll open the floor for the issue for discussion. Okay, starting the presentation, in a few words, what are the advanced traders? They are always algorithmic traders. They are traders where the human involvement is very limited, is limited to the early stage of the building of the algorithm. So human are involvement in a key way during the early phase of the project. They just decide how the rule should work, and they try to backtest before the algorithm became active. But this assumption is now, in this moment, is questioned by the increasing role of ChatGPTs and other very advanced way of replicating human thinking. So at the moment, I cannot say you with 100% of sincerity that all the algorithmic traders are built by human. I think that the most modern one are built by not human intelligence. Why to use an algorithmic trading? Just to avoid that our human nature push us in some situation, in some conditions where the probability of mistake is high, very high. So if we just leave the algorithm to make all the simple part of the word, the probability of mistakes is reduced to the much possible extent. So the algorithm, these are just rule-based systems, which decides the timing of the operation, the entry price, which is the price where an operation should be billed. For an operation, I mean a buying or selling operation. It is indifferent for an algorithm. For us, it is completely indifferent. The rule decide the quantity of stakes and the stop loss. The stop loss is the maximum loss tolerated by the rules, and the take profit, meaning the price where the profit is sufficient to close the position. In general, all these features are decided by the algorithm. In addition, the algorithm tries to monitor market condition in a continuous way and try to understand what happens into the markets so as to decide what to do with the position, to enter the position, to close the position, to reduce the position, or to increase the position. An important part of the story is that the fact that algorithms are now able to read the information in the exact moment the information is released to the market. The time an algorithm takes to read and understand the information is roughly 50, 60 milliseconds. 1 millisecond is 1,000 of a second. There are algorithms at the moment which work at the millions of seconds, and they are profitable. Moving to the overall industry and trying to narrow the scope to the most aggressive and modern algorithm, we have to understand that the advanced trading industry is a complex universe. In this universe, which is broad, which is dominated by pure market forces. This universe is very competitive. The profit of advanced traders are based on 3 features, which is latency, computational capacity, and holding period. This is a stylized graph or what I mean. The broader sample is just the algorithmic trading sample. It is a very broad spectrum where we find very simple algorithm or complex one. The complexity doesn't mean speed. Speed is one of the features which generates profit. And speed is measured by the latency. The latency is the amount of time requiring for a trading impulse to turn into an effective negotiation. The trading impulse just suffers the problem of the space, as everything. The nearer you are to trading markets, the faster your impulse reach reach marketplaces. So you are faster than others if you are located very close to marketplaces. Most of the modern trading systems are located into financial centers because of their need of latency. They just need to be co-located a few meters away from the NYSE, from the Italian stock exchange, from the Italian MTS, because at this level, 1 meter makes a difference. In this other dimension, we measure the computational capacity, which is the capacity of monitoring financial and economical and nowadays the geopolitical landscape and transforming each information input into a trading impulse. Those systems just surf the information, they analyze the information, they process it and transform it in a trading impulse, which is a buying or selling decision. The more power you have, the more able you are to effectively do this part of the story. So moving to the center, in this part of the universe, you can find the profitable advanced traders. I refer to this sample as a very aggressive and competitive word. It is really aggressive. Okay, and we will see later on. If you have some questions regarding some technical issues, please raise your hands before I go on. Okay. Now I'll try to give you a breakdown on the high frequency traders, which are just modern arbitragers. What is an arbitrage? An arbitrage is just a difference of prices which should not exist. If one apple, the value of one apple in New York is $1, the value of the same apple should be $1 in London. The same. For the same asset, in modern market, but market theory in general does not accept prices discrepancies. Otherwise, you can just generate a profit without any risk. You buy the apple where the price is lower and sell the apple where the price is high. Just normal economics. HFTs are very, very fast arbitrages. Modern marketplaces are fragmented. You can find an apple, a stock of apple everywhere in the world. There are a lot of marketplaces where you can negotiate apple or the Italian BTP or so on. So they just try to align the price into the different marketplaces. And given the being the arbitrage just a dollar on the ground, which is earned by the faster to take it, they just need speed to understand the existence of an arbitrage and exploit it and close the buying and selling operations to just close the gap. So they are in most of the case arbitrages or liquidity arbitrage. It is a pseudo arbitrage, a little bit more riskier, where they try to measure the imbalances of trading liquidity. There is a lot of demand in New York and a few demand in London. They just front run the liquidity imbalance, and they understand that the demand will be higher in New York and potentially the price will go up in New York before in London. So measuring the movement of trading liquidity, they can assess as a second round effect the movement dynamics of price and just close this pseudo arbitrage, which is not a pure arbitrage, but very similar to it. In a few words, most of their strategies are strategies related to exploit arbitrage opportunities, and they are positive for the market functioning. I put in green because, according to my perspective, those strategies increase market quality. One of those strategies, which is pseudo market making, is a little bit trickier because they try to replicate the behavior of the modern dealers, but without all the rules which modern dealers must fulfill in order to be dealers. So dealers offer liquidity in bid and offer, so in demand and supply. They are paid for this key role for the functioning of the market, but they must grant liquidity in every market condition. HFTs replicate market making activity, but not in all market conditions, only market conditions where it is profitable for them. So when market condition becomes a little bit more problematic, they shy away, leaving market alone. So this is why this kind of strategy for me is a little bit tricky to understand. At the end, I think this is harmful in general for market quality. At the end of this slide, all their strategies are aimed at discovering and taking profit from small and quickly fading market inefficiency. This is why their role is positive, because they reduce market inefficiencies, exploiting them. This is quite easy. If your nature is aimed at reducing inefficiency, your role is positive. In order to measure their positive role, financial literature, market microstructure literature, just generate a set of metrics measuring market quality. This is very stylized. There are much more metrics, but in theory, we can measure market quality just measuring the price discovery process, which is the speed of information incorporation. According to the FAMA definition of efficiency, is the most commonly used definition of price efficiency. A market is considered completely efficient if the information is incorporated instantaneously into price. So the faster prices incorporate new information, the more efficient is the market. And the other part of the story is the persistence of information asymmetries among participants. An inefficient market is a market allowing pricing asymmetries to last as long as possible, because the informed player are those benefiting most of the price information asymmetries. Just imagine Rockefeller into a couple of centuries ago. They strongly benefited of price asymmetries. They just build up a dominant position lasting decades. So this is why price efficiency is important for market quality. Moreover, the fragmentation feature is important. The most a marketplace is fragmented, the most the less is the level of market quality, because there will be possibility of arbitrage in terms of price efficiency. Even though a market is fragmented, the prices should be aligned. If prices are not aligned, the market is not efficient. Market liquidity is a subset of market quality measures. Market liquidity measures the cost of transacting each specific asset class. The bid-ask spread is a first measure of market liquidity. The bid-ask is the difference between the best price in bid and the best price in ask. In other words, how cost for an average investor to buy and instantaneously sell a stock. The wider the bid-ask spread, the costier is the asset class, the less efficient is the market. But this is just a first measure of market liquidity, because what we look at is the robustness of liquidity trading book. How many buying and selling orders are present into the books, trading books. Trading books is just are the places, the electronic places where stocks and bonds and FX are traded. The more robust is the liquidity, the more able are prices to incorporate huge trading flows. If I buy 1 billion of a very liquid asset, I will move the prices of just a few, a teeny percentage. If the asset is illiquid, I will move the prices of a huge amount. Okay, this is important. And the liquidity evaporation is a third level feature of the liquidity. How fast the liquidity tend to escape from trading books. The faster liquidity escape, meaning that more active are HFTs on that specific asset, meaning that if I think that at T+0, I will find a certain amount of liquidity on trading book, this amount of liquidity is not true. It will evaporate as long as I trade the asset. So this measure is just a sort of measure of the fake of fake liquidity which seems to be there, but it's not materially there. And lastly, we have some market distress measure, which just measure how the market comes under pressure in a volatile time. The most market becomes volatile in volatile times, the most market is prone to distress. The distress is important because if the market is prone to become distressed, you cannot trade with safety a single asset class, because as soon as possible, this asset class might become very, very volatile, thus requiring you to put in place some defensive activity. So those are very common metrics of market quality, and using some of those metrics to measure the activity of advanced traders, such as HFTs, we can find, and those are literature findings, that after the outbreak of HFTs in early 2000, in 2004, 2005, into the US equity market, most of those metrics improved, significantly improved. And you can see in a very impressive way here and here. This is the price dispersion, the possibility to make some arbitrage, just reduced to nil. So in the US, those graphics related to the US equity market. After just 2 years after the outbreak of the HFTs into the US equity market, there were no more disposable arbitrage. So the price efficiency became maximum. The serial correlation is the capacity of the market to incorporate new information. This indicates that when this is close to 0, there is no asymmetry information among players, or the asymmetry information just lasts a few seconds or milliseconds. And under this point of view, the outbreak of HFTs meant an incredible improvement of market quality, incredible. We had a tightening of the average beta spreads, an increase of available market liquidity, a reduction of the transaction costs, an enhancement of the price discovery process, an improvement of intermarket links because of HFTs needs modern infrastructure to exploit arbitrage, and a reduction of average volatility. If I stop here the presentation, the overall assessment will be completely positive. But it won't be true. It is not true. After a few positive valuation of literature since 2010, literature started to look at the positive hidden consequences of modern player. because HFTs and advanced traders in general are not only arbitrageurs, not only, even if they are mostly arbitrageurs, but some of their strategies are highly speculative, pure speculative strategies. The first speculative strategy is the pseudo market making, which is the last, which I rated here, pseudo market making. Then we have liquidity detection, trading on news, and momentum trading. Those are pure speculative trades strategies aimed at exploiting profit opportunities following the trend. There is a news regarding an asset, a positive or a negative news, that doesn't matter. Who earns the profit is the faster who understand the news and the faster who buys or sells the securities. Those are negative, those are speculative, but not negative, because they try to exploit price asymmetry faster than others. In doing so, they should be, I say that reducing price asymmetry is a positive feature of the market, but those are procyclical. They just, these strategies does not work only when the new information is given to offered to the market, but they start to act. They are ignited only also when there is no new information. They just intend the order flow to be an information. If a central bank buys a huge amount of a security, this is the new information. So they just front run the flow and they buy before the central bank because they can front run this flow. Under this point of view, as you can imagine, there is some problems regarding those kind of strategies. In red, we had the flash trading and pinging. Those are widely considered negative, harmful, denied strategies. They were inactive. They were very active in 2010, 2011, and then the regulators stepped in and decided to make these strategies illegal because of they were understandable, harmful for market quality. Just a few words regarding pinging. An HFT just generates thousands, millions, billions of fake orders in order to block markets, and generates as much as many as arbitrage possible. They just create the arbitrage, reducing market capacity to work. And under this point of view, this is truly harmful. HFTs adopting such strategies strongly benefit from their technological advantage versus other market participants. And those strategies must be relevant not only under a market quality perspective, but also adopting a policy standpoint, to the extent that they might even interfere with the proper transmission mechanism of monetary policy decision. We will see later on. So the relevance of those strategies is maybe at the maximum level possible. I will try to give you a case study regarding those three strategies: liquidity detection, trading on news, and momentum trading, so as to understand how they can generate spillover into systemic events. For a systemic event, I mean an event which has so big consequences that the general public interest is under threat. And the most of the event, which we will see, have been hugely assessed by the common newspaper, Financial Times, the Wall Street Journal, and so on. So the case study is regarding the liquidity evaporation, how a liquidity evaporation became a flash crash episode. What is a liquidity evaporation? As may be described as the sudden disappearance of liquidity from trading books due to massive order cancellation or modification by submitters. It could be linked to an informative shock, which is unexpected information, just the release of a data of a macroeconomic data, or the publication of corporation results, or unexpected new information. The unexpected new information is the failure of a bank, an earthquake, an attack, and so on, but also a trading flow coming from a sufficiently big market player. And this is the key of the story. The liquidity evaporation means not only a widening of the bid-offer spreads, but also an increase of buying and selling overall costs. Above all, the overall liquidity on trading books shy away. There's no more liquidity on trading books. This affects the resilience capacity of central limit order books, the trading books, thus amplifying the market impact of existing orders. The fewer, the less liquidity, the bigger the price impact of incoming orders. So the liquidity evaporation episode often comes along with a significant price swing. Here I have a stylized graph of how it works. In red, the histograms in red, we have the overall resilience of market liquidity. The higher these histograms, the sounder the resilience. So the liquidity, the resilience of trading books is average here. Then suddenly there is an information shock here coming to the market, and then we have the liquidity vanishing away because of high HFTs. They understand faster than others that something is happening on markets. They understand that something is going wrong. Some of them also are able to understand what's happening, but most of them just understand that there's something that not working properly into the market. So they fly away from trading books in order to avoid losses. They fly away, so the trading liquidity, the market resilience is compromised to the extent that there is no more trading liquidity at some point. But exactly in this moment, HFTs, which were here offering liquidity, they deprive market of their liquidity and start to ask liquidity because they start to buy or sell accordingly to the news. So they move from being liquidity providers to become liquidity takers. So they just sum up to the existing trends, and they exacerbate the trend to levels where the market does not function anymore. So they just break the market. Here, the market does not function anymore because prices cannot rely on sufficient amount of liquidity to properly reflect the risk behind the price. So the prices start to move away from the fair value of the asset. In this moment, there are incredible profit opportunities because price does not reflect the truth of the market. So the faster you are to understand that prices are far away from their fair value, the more capable you are to buy or selling at lows or highs, because those levels should not exist. Prices should be here. So they, from being liquidity supplier, they become liquidity taker, and at some point they start to offer the liquidity again, buying the security again, and moving the price toward again fair prices. So the episode, in theory, and in most of the cases, just come and fly away, and nobody understands what's happened. Just the less informed players lose a lot of money, and those money are earned by the faster traders. But in some conditions, this phenomenon, which is not particularly harmful for market quality, just became just go out of control. And I can just skip this. And liquidity evaporation could be just considered as a first step of the series of the events that may potentially fuel a flash crash event, which is the systemic event. Liquidity evaporation may evolve into a flash crash due to a series of automatic sequential steps, which is named cascading effects. Once a liquidity evaporation episode happens, the price impact of market orders and the short-term price volatility increase, as we have seen. Speculative activity speeds up, with many short-term traders trying to follow the trend. There is additional selling pressure, which may be related to volatility-induced sales or stop-loss activation. Why? Because if I have a long position here, I'm forced to close this position. So I'm forced to add selling pressure because I cannot deal with these losses. So this is automatic. I cannot decide. This will trigger additional selling pressure, increasing short-term volatility and so on. And the degree of the movement just raises the attention of retail and institutional traders, thus forcing them to liquidate their position. In this moment, there is the activity is most of the cases related to retail investors. Okay, they are the bottom up, the final taker of the losses. But if the episode becomes very wide, the losses are just tend to affect huge portfolios, reserve portfolio, insurance companies, pension funds. So the consequences in terms of market quality, but in terms of public interest, are not negligible. In some cases, they are relevant, significant. And I have 3 examples. This is the first flash crash happened in 2010. It happened on the Dow Jones Industrial Average, maybe the most liquid, the most famous index of the world. Out of the blue, nobody expected it. The 6th of May 2010, the index dropped of roughly 10%. With no news. There were no single news behind the movement. And after a couple of hours, the prices recovered most of the losses, and the prices and the index closed with a loss of roughly 3%. So if you have a weekly or monthly, but even a daily observation, you even see this episode. You cannot even see the episode because it is just an intraday movement. But here we had roughly 10 billion of wealth transferred from highly sophisticated, from low sophisticated players to high sophisticated players. So it is just a huge transfer of wealth. But then we had those episodes start to happen also for core markets. What are core markets? Core markets are those markets which are relevant for the conduction of the monetary policy or for the usage of public finances. The government bond market, or the money market rates, or the FX markets. From the equity side, which is a pure speculative market, those movements started to happen also into other markets, and they started to affect the FX, the JPY, the Japanese yen, then the sterling, then the Italian markets, and then we have a huge episode affecting the US Treasury market. The US Treasury market is the market where the public debt of the US is traded, roughly the biggest market of the world. And during October 15, this is the yield of the US 10-year Treasury. The yield in 1 hour dropped from 215 to 185. In historical terms, such a drop is here. So it is a drop consistent with the attack of the Twin Towers or with a war. It is a drop which is consistent with a huge depression, with a huge recession. What happens here? Nothing. Just the release of one single macroeconomic data, the retail sales of US, a little bit disappointed. But the situation, the cascading effect was so huge that the that such a relevant and incredibly liquid asset class move in this way. It is called a 20 sigma movement, a movement which is expected to happen once per 1,000 years. Okay, it was a huge movement. And which were the systemic relevance of this movement? They were significant for a lot of under a lot of point of view. First of all, the monetary policy point of view. The Federal Reserve uses the US Treasury market to understand to what extent the monetary policy impulse into the US is being transmitted to the households, to the enterprises. If something is happening of the US or on the US Treasury market, the Fed will be forced to change their monetary policy tone, because there is an impact on the monetary policy transmission mechanism of its decision. So the Fed was forced to look at the episode and understand if there were some monetary policy implications related to the episode. And this is one implication. But being in 2014, I was the portfolio manager of the US portfolio of the Bank of Italy. I had a long position because of other consideration, mostly macroeconomic consideration. So I had a position on US Treasury market. I was long on the US Treasury market, and in this moment I was earning a lot of money, but just for luck. If I were short, I had to close the position because of the volatility of the losses were unsustainable for a central bank. So I should reserve currency investor and pension fund and insurance company might be forced to do something that they won't do otherwise. At the end of the day, the movement was zero. The yield moved from 215 to 215 again. So if I closed here the position, I just embark a losses of $100 million, $500 million. I could go bankrupt because of something that is not supposed to happen, and at the end of the day, it's not happened. Okay. And on the back of what I said, there are some potential negative effects related to the high-frequency traders and other advanced traders. And those effects have been understood also by regulators and supervisors. On the back of the echoes of main flash crash among public opinion, researchers focus on the potential hidden harmful consequences related to the massive adoption of HFTs. What are the negative effects? Adverse selection. The adverse selection is just selling here what I don't want to sell. Being forced to do something that otherwise you have never done, you wouldn't ever done. Herding behavior, pushing a lot of people to do something altogether because of they think that something is happening, but in reality nothing is happening. Huge informative asymmetry. Where the informative asymmetry happens, it happens here. Prices here are completely asymmetric. Informed players knows that something is happening, while non-informed players are just fearing that the situation could go out of control. So the information asymmetry lasts 5 minutes, 10 minutes, 1 hour, no more than 1 hour, but it is huge. And finally, front running, just understanding what the herding behavior is supposed to generate and anticipate it. To sum up, all these negative effects could generate a bad equilibrium. What is a bad equilibrium? Is a situation so much deteriorated to the extent of affecting economic and the fiscal situation of corporation and government. So in a bad equilibrium is an equilibrium which is not supposed to exist, and it is self-fulfilling. Just imagine the Italian Treasury issuing an Italian BTP during an episode of during a flash crash. The yield which the Treasury will pay is roughly 50 basis points higher than the equilibrium rate. This 50 basis point, if measured on the average issuance of the Italian Treasury, which is 10 billion, it's a huge amount of money. This affects the fiscal soundness of Italian government, and so on and so on and so on. So the public interest is put under threat. But moving to the end of my presentation, the high frequency, the advanced trading landscape and the high frequency industry is a highly competitive landscape. The biggest threat to the profitability of HFTs is represented by other HFTs. It is an arms race for having the technology, the know-how, the human capital. This is the first graph, but just putting here the investments. In order to reach this point, which is a sort of break-even point of profits, the investments are huge. You need to hire the most valuable traders into the industry, so you have to pay them. You need a lot of engineers, you need a lot of mathematicians, a lot of quants. You have to pay them. And you need the latency, and you have to pay the location. So an HFT, a modern HFTs, has a lot of investments. It is like Amazon. It is like a modern enterprise. It's a bet. You do not know which is the level of the technological level of your competitors. So you make a bet. And if the bet is profitable, you will earn a lot of money. But it is an unstable situation. At the first, if you are the first comer that's bought in 2008, the gap versus competitor is huge, but the industry is very competitive, so the gap is rapidly filled, and it is an unstable industry. So I close here, opening the floor for a discussion regarding the speculation and price efficiency in general. Is speculation fair? In my opinion, speculation is fair. It's truly fair to some extent, because speculation and HFTs and algorithmic traders just increase the price efficiency. And if there is someone who's not fulfilling the rules, nowadays it's just a sort of a question of minutes. All the markets will know that there is some fraud, some problems, some economical backdrop in some balance sheets. So to some extent, the speculation is fair, is good, but there is a level where speculation is harmful. It's just a question of level. HFT, like Amazon or other modern firms, is a consequence of the technological developments. It is a landscape very competitive, where you need a lot of investments and you burn a lot of risk. The dominance of a single HFT is short-lived. We had an HFT which could generate billion in a single year and became completely bankrupt into the second year because of the gap is filled, rapidly filled. They generate market which are procyclical, which generates flash crash. But nowadays, my biggest fear regarding market complacency, and this part is related to this, to the massive use of non-human intelligence to program the algorithm. Algorithm, under this point of view, are starting to become similar each other. They do the same thing. So they just generate market environments which are complacent. There should be also 100 days in a row of equity a green days in equity space, but not because there are no risk, but because algorithm does not understand risk, because they are similar each other. So just do the same thing. They just are long only or short only. And as they generate complacency into a positive environment, what I fear is what happens when the environment starts to become not so positive under their lens. They could generate, and this is my call, they could generate huge pain. And finally, regulators and supervisors are key as often, but in this landscape, they suffer from a huge difference of resources dedicated to the analysis of the topic. HFTs just hire the best know-how, have retained the best know-how. Regulators have a different balance sheet, so they are not able to hire all the workforce needed to properly analyze the issue. So I can stop here, 5 minutes ahead, and I open the floor for question if you had one.
And thank you very much, Alfonso. That's a very interesting talk, and so we can now open the debate. So I have questions, but of course I leave the floor to other people if there are questions coming from the audience. So I think they could make raise their hands, so and then we can make directly in the video the questions.
I think Lisa has one.
Okay, maybe you can. Okay, see. Hi, Lisa. So
sorry, I couldn't find my where to raise the hand, mechanically. I apologize. Thank you for a really interesting and informative talk. I wanted to pick up on some of the problematic features of HFTs and ask you what you think we can do to mitigate those. So you had been talking about the flash crash, and I think subsequent to those crashes, we then halted trading at a certain point. The markets did. But I wondered if you could say a little more about that, how we could address the problem of flash crashes, but also the problem of pseudo market making. And I'm thinking of the case, maybe it's a year ago now, where JP Morgan had a couple of traders that were spoofing the gold market, and they would create sell orders and then get the algos moving and then come in to buy at a lower price. And I'm wondering what tools we have to address those problems that go with the HFT market.
Okay. So I can try to answer your question. Many thanks. And regulatory response has been a little bit slow at the beginning, because I have a slide, because they were unable to understand the phenomenon into the early stage of the phenomenon. It just built up under the radar, then exploded suddenly in 2010. Really suddenly, with a bang, with the flash crash of the Dow Jones. But more recently, into 2014, 15, and 16, the regulators in US and in Europe, UK also, made a lot of the step toward a better understanding of the phenomenon, and they decided to introduce a set of new rules which are aimed at mitigating the effects. And those, we can find some of those rules. First of all, anti-disruptive trading rule. In other words, when the situation is becoming out of control, just close the market. Close the market. Just make the market into the condition to regenerate demand and supply. just stop. We had those kind of self-protection rules into the NICE, but in all modern markets. Then started to require some latency speed bumps. So when an order reaches the market, just the market holds the order for a fraction of a second before the order reaches the market. So in order to mitigate the speed advantage for the most aggressive one. Then we have the order to trade ratios. This is not a rule, but just a monitoring of activity. The traders, which at the end of the month, the week, of the day, I don't know exactly which is the time frame, have a very huge order to trade ratio. They are supposed to be HFTs. So they are required to generate to give additional information to marketplace in terms of risk management, risk operational management, and so on. And we had a huge effort in terms of regulation and monitoring marketplaces. The central banking and supervisory, the global central banks and supervisors are now monitoring on a continuous basis the modern market, the relevant core market, and work very close to regulators in order to help to understand if the situation is going out of control. At the moment, the flash crashes have been addressed. The problem regarding the flash crash was addressed. We had just few flash crash happening recently, and none of them systemic. So I think that under this point of view, the effort was positive. At the moment, we have this problem, the complacency problem, which is building up. But I think that we will understand the degree of the level of this problem later on once the dark side will materialize.
Yeah, if I could maybe ask one follow-up question. Thinking, maybe part of the dislike of HFTs, among retail investors, has to do with how they might be impacted. So if I'm a retail investor and I have, and I'm investing, longer term, and I have stop losses in place, then I might, those might go off in the event of a flash crash if it's not, blocked soon enough. So I'm wondering if, in addition to addressing the systemic problems, do the current tools that we have also protect retail investors sufficiently in your view?
Yeah, okay. The retail investors is still a problem, but I think it's related to the time frequency of a retailer's activity. If retailers want to play a game where predominantly HFTs are profitable, I think that it is just a decision, an investment decision. You can address the problem by increasing the awareness of the large public. You should make large public to understand that if you are a daily traders, you are dealing with those kind of players.
Yes.
So increasing the awareness is a way of fighting the problem and addressing the problem. Otherwise, if you just think on the other way around, we as a system, we will just avoid, limit or avoid the participation of HFTs. Okay, this decision will make most of modern marketplace to go bankrupt, because their profitability rely on the commissions generated by HFTs and algorithms. So I think that the decision will be more harmful than positive. Okay, so I think that the most transparency and public information regarding those kind of activity is by far the best way to deal with it.
Okay, good. Thank you.
Welcome. Maximilian.
Hi, my name is Max. I'm a PhD student from the London School of Economics, and thank you so much for the interesting presentation. I'm researching into algorithmic trading systems and specifically their failures. So the failures that you mentioned around the flash crash are quite similar or interesting to me. And I just have a question, because I realized that a lot of literature and what I've seen talking to banks with, most of these algorithmic trading systems are focused on HFTs. But I fail to see that trading systems in general seem to look at long-term environments, if I'm not mistaken, because predominantly the literature is talking about HFTs. And my question just for you, out of your experience, maybe was on this specific topics, did you see that as many as there are HFT strategies, there are also strategies, I don't know, on quarterly results, for example, or maybe even long-term strategies that are coming and executed from algorithms in general?
Yes, I grab your point. According to my my perspective, HFTs, the holding period or HFTs is 99% a daily. They just enter and after a few milliseconds close the position. They do not have long-lasting higher horizon trades. No, those are human trades. They are pure human trades or trades generated by very sophisticated artificial intelligence algorithm. Right. This is a different part of the story, according to me. What I'm seeing is an increasing use of execution algorithm, which are algorithms aimed at minimizing, reducing the cost to implement huge trades. The execution is made by algorithm, but the decision is human.
Understood. So basically the algorithmic trading decisions or trading systems that you see right now are very specifically to a small holding period, such as high frequency, rather than, let's say, 5 minutes or maybe even months of holding periods.
No, for monthly, for those kind of strategy, the human involvement is key.
Okay, understood. Thank you so much.
Welcome.
And thank you again, Alfonso, also Maximilian and Lisa again. And maybe I have a question about, I mean, I try to put on the table a philosophical question. And one is about the way algos produce interpretation of the news. I guess that that's I think a delicate point, in the sense that for some news, of course, the reaction of the algos will be the same, but the news can be a bit more complex, and so the reaction can be different, and then can create maybe artificial niches that are more unstable, I guess. And a second question, which is tied to this one, is you are right in the sense that the flash crashes are decreasing, but there are markets where automatic trading is increasing, where we can see an increase in volatility, and so those variations or prices reminds me of human markets, where fear and euphoria are exacerbated. And so in this sense, maybe it's a bit surprising, in the sense that I see more the human markets produced by algos, while maybe one of the functions of the algo is to be a stabilizing force in the markets. And so that's a kind of paradox, but maybe not, because we are the one writing down the algos. So I would like to hear about your opinion.
Yes, I will start with the second part of your question. Your second question, I think that the most sophisticated is the market. The most positive is the impact stemming from HFTs. The less sophisticated, the more procyclical is the impact. Okay, so if a market, if into a market operates just a few HFTs, they will, on average, try to exploit momentum strategies because of they will generate and take profit of price asymmetries. So they will be, in my opinion, non-concurrent, non-competitive. They will just behave like into a semi-monopolistic environment. But if the market is sophisticated, meaning that there are a lot of HFTs active there, the competition will increase the advantage of having HFTs, the competition forces, because you will have procyclical HFTs and contrarian ones. So they will just fight each other, and prices will benefit, price efficiency will benefit from it, from this. Regarding the reaction on news, the news, how are news released nowadays? The news are released by information provider, Bloomberg, Reuters, MNI, a lot of information providers, but the first release is just a line. BTP's issuance is increasing, okay? It is a way of releasing information which is palatable for algos. So they have just to understand a few words. This is the top news, okay? Then you will have the other part of the story. So the first reaction is just based on a few set of words, where the natural language process is the work of a natural language process system is quite easy. Then you have to understand the overall picture, and in this part, human involvement is still key, but there is an increasing involvement of artificial intelligence readers. So this is why I fear the complacency of the market, because the market standard is moving from traders, we just read the release of the line, to algorithmic traders, which read the overall news. And they read the overall news in the same way, because the rationale behind, the algorithm behind is a sort of standard industry. So this creates a lot of complacency into the market. This might create.
Thank you very much, Alfonso. Again, it was fascinating, and I hope to have the opportunity to have you on finance again sooner or later.
With pleasure.
If there are no other questions, I think we can stop here and say thank you again one more time.